sizes are very personal and very strategic. So, how do private money lenders decide on a loan size? Honestly, it is very personal. So, first of all, the main thing to think about is like how much capital is the private money lender, you, actually working with. Now, a lot of private money lenders, or most private money lenders that I know, are loaning out their own money. Now, I know the term private money lender is being thrown around to mean all kinds of different things, right? Some people confuse it with hard money lenders. Some people are talking about funds where the primary fund manager is raising capital from a bunch of different investors and then loaning out the money and calling it private money lending. Now, what I'm talking about is direct lending from a private lender like me to a borrower or investor, right? So, if you think about the fact that I'm loaning out my own money, the main thing here is that the limit is going to be based on what I actually have, right? So when I started private money lending, I started with my old 401k. And so when I spoke with the attorney that helped set up my self-directed IRA for me, it was really about managing risk of private lending given the money that I had. So I rolled over about $60,000, which is not a ton of money, right? Now, I didn't want to do a loan for $60,000. And so this is the conversation I'm having with the attorney, because it's like, okay, you don't want to have that much exposure, like 100% exposure is a bit too much. So I had to really think about, what am I comfortable with if, God forbid, everything goes wrong and I lost this money, would I still be able to do something? And so it comes down to like, how much money do you start with and are you working with? How much exposure are you comfortable with? And then what else might you want to do with the funds in there? Okay. So it's not just about the actual deal. It's very personal to what the private lender has to work with. Now, of course, over time, my fund grows, and the more loans I do, the bigger it grows, and so I can do bigger loans if I want to. But that's the very first piece of that. It's really like what the lender has. And so sometimes you'll see private lenders working together to provide the funds for a transaction because maybe separately they cannot do it. And so they bring someone in. But again, that's still very different from someone who is funding a loan from a managed fund of other people's capital. Okay. Now, in terms, like, we already got past what the lender actually has, but in terms of what the borrower needs, the loan amount isn't always based on exactly what the borrower needs. Now, a lot of private lenders prefer that the borrower has some skin in the game. I don't know if you've heard this phrase, but it basically means they want the borrower to put some of their own money in the deal as well. If you're asking me for money to do a rehab and you want $100,000 and you've borrowed the money from a hard money lender to acquire the property, let's say you got it, with no money down, and you're asking me to fully fund the rehab, at this point, you have no skin in the game, right? So if something goes wrong, there's no risk for you really, right? And so sometimes private money lenders will be like, okay, I understand you need 100,000, but I need you to come up with 20,000, okay? And then I can, bridge that gap and provide the other 80,000. So sometimes it's not that the private money lender doesn't have the full amount. It's just that they're not comfortable funding the requested amount because maybe the risk profile is too high. Maybe the borrower doesn't have enough skin in the game. It could be all kinds of reasons. Another thing to think about is the relationship between the actual collateral and the lender's exposure, right? So maybe the collateral's value isn't what the investor thinks it is. Maybe the investor and the lender don't agree on the value of this collateral. And so the lender may be saying, "Oh, I know you said that the ARV is 500,000, but according to my research, I'm getting 350. So I'm not willing to loan you 400,000 because I don't think the property is worth that and I don't think you're going to be able to sell it for that. So that may be another reason why they may change or be unwilling to fund the full loan request amount just because they're not on the same page in terms of the collateral. Another thing may be just where the private lender is in their business. So Many new private money lenders, they get into the space and they're nervous and they're not sure how it's going to go, and so they want to start small. And small means different things to different people. It can mean $5,000, it can mean $10,000. But that lender may say, even though I have $500,000 to loan out, I only am comfortable loaning out $10,000, even if the borrower is requesting 20,000, And so that's just something that is very personal, and the borrower has to decide if they want to work with that lender. But it may not be anything to do with the borrower or their project. It may just be the private money lender and their own preferences. So loan sizes are strategic decisions, and it's really a collaborative decision between the private money lender and the borrower. And it's not set in stone, right? So even though the investor may be requesting a certain amount, doesn't mean that that's going to be the amount the private money lender is willing to fund. And they may come to some different agreement. Maybe putting more skin in the game can help lower the interest rate, etc. It really just depends on the particular circumstances that have to do with that project.